Welcome to The Point of View. This is your favorite current affairs show on television on City TV. On The Point of View, we pick the right guests, ask the relevant questions on issues that matter to you. Tonight, we're going back to the economy of Ghana to examine where we are. Ghana's economy has been going through some major challenges following the kicking out of Ghana from the international markets sometime in 2021, the debt exchange in 2022. We've seen some very interesting numbers. I'll be speaking to a financial analyst with 30 years of experience working in the sector, with his views on where Ghana's economy is. Have we turned the corner? And why he thinks an optimal reserve ratio for gold will help Ghana's economy stabilize in a more meaningful way. All this and more when we come back. Stay with us. Welcome back. So Ghana's economy has been going through some pretty tough times starting third quarter of 2022. We've shown before in previous programs where the economy of Ghana is. The inflation rate for Ghana went above 50%. Now, if you think about the target rate for inflation, plus or minus 2%, plus or minus 8%, that should tell you how seriously the economy went through the doldrums. I'm going to show you the latest figures from the Bank of Ghana released in January this year as to where the economy is. When I'm done, I'll speak to Kofi Aka, who is a financial strategist with 30 years of experience in financial sector, worked with IFC World Bank. He's also done some work in other sectors as well. So let's talk about the interest rate. So this is one of the key things you look at when you want to discuss the economy of Ghana. Now, these charts start from the 2021 all through to 2023 ending, and the figures are pretty dire. If you look at the rise of interest rate, for example, the numbers are not looking that great. So if you check the first slide on your top row on your left, you're looking at interest rates which are going up all the way to the close to 30% rates, the monetary policy rate. This is the rate that the Bank of Ghana's Monetary Policy Committee usually uses as an indicator of where we are. There's also the Ghana reference rate, which seems to behave in the same pattern as the monetary policy rate. And as a consequence, the third column on the first row, the average lending rates, also pretty high. We notice a dip from January 2023, coming down slightly to above 30 and then continuing up. The average lending rates are much higher than the monetary policy rate because the highest level of the monetary policy rate is 30% in that chart on the left quadrant. But in the right, it goes above 35. So the average lending rate seems to go higher than monetary policy rate. There's also the interbank rate, which is also pretty high and follows the same general pattern of interest rates. So that's in the bottom left. Now, the T-bill rate, which we'll talk about later on, in the middle of the bottom row, 182 days the red, 91 day is the blue. Now, T-bill rates are short-term lending, right? And again, the T-bill rates came down January 2023, started moving up again, went close to 35 before January 2023, and is moving close to 32 within the same period. The 364 T-bill rate as well is rising. Now, rising T-bill rates are problematic because the T-bill is short-term instrument. Essentially, you're saying if government borrows from you for the short term, they're giving you much higher returns than if they borrowed from you for a longer term based on a debt exchange. If government borrowed money for 10 years or 5 years from you, the interest rate they would pay you back would not be up to 20%. In fact, the debt exchange lowered the rates and extended tenors. So what your high T-bill rate means is that you're going to have an inverted yield curve because essentially the longer the tenor, the higher the rate must be. And in most advanced economies, if you have an inverted yield curve for 2 quarters, you're heading for recession. So that's the first chart to look at. The interest rates are going up. The MPC meets in a few days' time. The last time they reduced their rates was 30% to 29%. People like Toby Afede thought that it was a joke. In fact, Toby Afede penned an article dated Bank of Ghana's 1% rate cut is a big joke. That's February 4, 2024. Essentially saying, after having 6 months of 30% monetary policy rate, why on earth would you reduce it by only 100 basis points to 29%? He felt that didn't make any sense. The Bank of Ghana was making too much profit and private sector was being crowded out. So the interest rate figures are not the best. It doesn't tell the best story for Ghana. Second thing, as a consequence, you have the inflation and the exchange rate story. So that's my second chart I'm going to show you this morning or this evening. Now, take note of headline and core inflation. Again, it went up all the way to beginning of last year, started coming down. So that's the top left chart on the first row. Now, take particular note of the middle in the first row. Food inflation is much higher than non-food inflation. So essentially, prices of food are going up at a faster rate than prices of non-food items. So you notice the food inflation in the blue and the non-food inflation in the red. That's a problem because poor people spend a larger chunk of their income on food. So if you have higher food inflation, it's not a good thing. Headline inflation, which is the monthly one, that's much lower, but it's still a problem, follows the same trend. And then you look at the exchange rate as well. So come to the second row. US dollar is the first quadrant on your left, right? It went all the way to close to 13 prior to January last year, came a bit lower to 8. It's inching up again. The pound as well, as of January this year, selling at 15. So January 2024, the dollar is selling at 11.96, almost 12 cedis to the dollar. The pound is selling 15.2 cedis to the pound. And then the euro as well, 13.03. The key point to note is that they are inching upwards. That's the challenge, right? As a consequence, the bottom row, all those figures there have started inching up again. Now, there's a third chart, which is what we call the high frequency economic indicator. So these things put together show the real economy. So it's not just the monetary numbers, it's not just the rates. So this chart is very important. You have the real composite index for economic growth. That is a bit positive. So if you look at the chart in the top left corner, it came down all the way to January last year, started inching up again. So it's a composite index of economic activities growth. So it looks like some level of production is happening in the economy and things are inching up. But look at the chart in the middle on the top row. Very serious. So you have what is called your real or retail sales. Your retail sales is the blue line at the bottom. It's very flat. People are not buying. But look at your VAT collection. It's in the red line. It's much, much higher. So government is probably overtaxing companies just based on this slide. Because if you are collecting tax at a higher rate than people are selling, it's what people sell and buy that you get your tax from. Most of our taxes are indirect taxes. So the middle chart is not a good sign for the health of Ghanaian businesses. A few other things to take note of. Cement sales. That's the third column on your first row. Plunged down, but it started recovering slightly. So cement sales is going up. Port activities, check it. That's the second row. Passenger arrivals as well going up. That's always gone up. Ghana is always a good place for travel. SSNIT contributions also going up, but the last chunk shows is coming down. So again, the figures in this chart present a checkered view of the economy, right? And very important to note the difference between the VAT collection rate and the retail sales. Let's go to the third one, monetary development. This is very important for our discussion today because my guest argues that the best way to protect Ghana's economy long run is to increase our gold reserves. So we are not overexposed to the strength of the US dollar and what happens when the Fed in the US and other economic agents act. It basically says you have to back your reserves not just in dollars but in gold. If you increase that percentage, whatever happens in the world, you have enough money to support your currency. We'll talk to Kofi Aka about that. But let's look at monetary growth. So in your first row, you have what is called the reserve money growth. Went up, peaked close to end of 2022, started coming down all the way. Quite a huge sort of trajectory from around 25% January 2022, got to 60% end of 2022, came down to below 0% because of all the IMF deals. So essentially government couldn't print any more money, but it started going up again. Currency outside the bank's growth as well went all the way up, started coming down. Foreign currency deposits, we'll come back to this. Again, somewhere middle of 2022, 23, it came down to below 0, started inching up again. And then there are things they call M2 plus growth. My guests will discuss and explain some of these points. But it's important for you to note that the Bank of Ghana has played a critical role in some of our problems in terms of 60 billion printed. They printed up to 60 billion. The government has also borrowed about 48 billion cedis, the finance ministry, through the short-term money market, what we call the T-bill market. 48 billion in 2023. That's a lot of money to borrow. Let me end with this final chart for the segment, external developments. Now, Ghana's major exports are cocoa, gold, and oil. Now, look at the behavior of cocoa prices in the chart on the left. Cocoa prices year to date, December last year, 66.8%, going up. That's not a bad thing, right? There's a chart that shows the difference between realized and real. That is the more important chart. But suffice it to say that the cocoa prices are going up, but because Ghana's cocoa production is going down, indeed, the cocoa production is so low that we are not going to realize a lot of benefit from the higher cocoa prices. We export cocoa beans raw, so the higher the price, the better for us. But that doesn't seem to be helping us at all. Now, come to gold, which is really one of the reasons we are doing this show. Gold price again. Look at the behavior of gold prices. This is the third column on your top row. Fluctuating pretty seriously. Went up to 10%, came down to below -5. It's going up again. And then as a consequence, our exports and our imports and all those things reacting. And then the final chart is the banking sector indicators. The most important chart there is the chart right there in the middle for me, where you have your non-performing loans and adjusted NPL ratios. Very troubling indeed. People are borrowing and not paying back. So these charts together paint a checkered view of the economy of Ghana. But let me talk to my guest on what he makes of these numbers, because the big question for the economy of Ghana is whether we've turned the corner or not. So Kofi, I don't know if you've been following my train of thought. Thanks for joining us. Good evening. Thanks for joining The Point of View.
Good afternoon, Bernard. How are you?
I'm very well, thank you. And how are you doing?
Fantastic. Want to speak with you again.
Wonderful. I noticed you've been writing pretty aggressively these days. You went down the radar a bit, but your appetite for writing about the economy of Ghana has come back up. What is the reason? Is it that Ghana's economy is now of interest again, or we've just been busy in the past?
You are spot on with your analysis. Back in 2017 was when I wrote my last major piece on Ghana's economy. And this was right after the 2.25 billion cedi denominated bond. And it was also after the authorities, in particular His Excellency the Vice President, had come out and stated what his primary monetary policy was, which was they were going to run an equilibrium of cash reserves to foreign reserves. So a 50-50 ratio. Immediately, I knew that was unfit for the 21st century, because I'd been doing research. And as you know, I've been talking about growing Ghana's gold reserve for quite a few years before 2017. I think I started talking about it back in 2011 or 2012, as I saw all the flows. And, you know, I'm a subscriber to the World Gold Council's newsletter. And that newsletter was showing all the gold being bought and flowing out of Ghana and all the countries that actually produce gold and being bought by central banks. So monetary policy was changing, and it's changing from the 20th century to the 21st century. And unfortunately, Ghana's strategy back in 2017 was recycled in pre-2008 global financial crisis. So if you're going to run a monetary policy with an equilibrium of cash reserves to foreign reserves, and most of your foreign reserves, in fact, 93%, 92, 93% are actually cash, foreign cash, reserve currencies that also depreciate against gold.
Recording stopped.
So you've got two issues here. One, your currency, the cedi, is already depreciating against the dollar. Secondly, the dollar is also depreciating against gold. And here we are in Ghana, the #1 producer of gold in Africa. And our gold reserve was at 7.7%. That is not a foundational pillar for monetary policy in the 21st century.
This was the basis for your article in April 2017, asking for a best practice gold reserve ratio. This was the basis for that proposal.
Correct. Now, my premise was the following. As you know, I put together a fiscal policy. I don't want to get too much into politics here. I want to talk about economics. But as the economic and finance spokesperson for the CPP, I put together a fiscal policy, which was fit for the 21st century. And that was based on 5 pillars. If you remember, energy, labor, education, ICT, and financial services. And then when I left right after the election, I knew that we needed to craft a new monetary policy fit for the 21st century. So I came back to Washington, D.C., and as you mentioned in your introduction, I used to work at the International Finance Corporation, which is part of the Bretton Woods institutions. So I had access to the IMF and the World Bank libraries. So Bernard, I'm a patriot. I went into the IMF and the World Bank libraries back in 2017, and I pulled data. I pulled 10 years of data at that time. I have 15 years of data now, but 10 years of data, 13 data points, and 4 countries, 2 monetary blocks. And basically what the data showed was that we were moving from a gold reserve ratio to cash reserves ratio around the world, particularly for developing countries, moving from the low single figures to the teens. But the question was, what is the right ratio? So everybody's growing the gold reserve, but what is the right ratio? So I took it upon myself to think through these issues and to think through both top down, but also to do the work from the bottom up. And in terms of bottom up, there was still all of these flows happening, and you couldn't really tell where the optimal ratio would be. So I did the following. And of course, my thinking evolved over time. But essentially, I looked and I said, okay, the monetary blocks I looked at was WAMU, or the CFA countries, which are the countries that surround Ghana and the West African Monetary Union. So that's one. And then 2, I also looked at the European Central Bank. And the reason I looked at the European Central Bank was the following. 1, 50% of the reserves of WAMU and the CFA are held with the French Central Bank. The French Central Bank is one of the founding actors to the European Central Bank. That's 1. 2, WAMU economies tend to have 2 things. 1, narrow current account balances and fiscal deficits. So we're having narrow current account balances, narrow fiscal deficits, and we're putting 50% of their reserves with the French Central Bank, and the French Central Bank, being the founding member of the European Central Bank, and the European Central Bank running an optimal reserve ratio of, let's say, 20%, 27%, plus or minus 3. And that has evolved over time because, as you see, between 2017 and now, they've actually grown the optimal reserve ratio as well.
All right.
Now,
Kofi, just hold it there.
According to Mario Draghi.
Before we get into the technicalities, I think we need to just make some things very straight. You're basically saying that for a country to secure its currency and to be macroeconomically stable, its foreign reserves, which is the amount of foreign currency it has, there should be a ratio of what is cash and what is non-cash. And your point is that the ratio of non-cash to cash must be higher than what pertains in Ghana. So if, for example, you have 100 of foreign currency, as of the time you wrote this article, less than 8% of it was in gold. The rest of it was purely cash. But you're saying if you want to secure your currency, you need to increase the reserve of gold and non-cash in that reserve. I'm asking this way because not everybody understands ORR, not everybody's listening to an economist. So they may not be interested in all the technicalities of what the UMY is doing or what another person is doing. So your basic premise is that you need to have a larger chunk of your reserves in metal, like gold, instead of pure USD. Is that correct?
100%, Bernard, absolutely. So again, look at your balance sheet. If your balance sheet and let's say, it makes up 100. Back in 2017, 92% of that was cash, foreign cash. 7.7, 8% of that was gold. Now, a gold reserve is a reserve of safety. A gold reserve provides fairly good protection against the fluctuations of the dollar. And in terms of the optimal reserve ratio, it also dovetails with sort of private sector financial capital structure theory. So again, I'm using all my experience, but I'm also using data. So if you go and you look at any finance textbooks, they talk about an optimal capital structure, which is, how much debt should a company put on in order to be able to operate most efficiently. Kind of using the same principles here to come up with what is the most efficient capital structure and reserve structure for Ghana. Obviously, 7.7% was not the right ratio. I think we are on the right path right now with a ratio which is, I believe, at 38.5%. The ECB is running right around 33.5%. And so, what I'm saying is that having a gold reserve ratio that is approximately 35% plus or minus 3 will give you better stability to your currency. 1. 2, this ratio also allows us to replicate the structure that our neighbors have. And our neighbors, which are the CFA countries, they've got lower interest rates, they've got lower inflation rates. And, if you look at the development of those countries, particularly the larger countries, Cote d'Ivoire and Senegal, over the last 7 years, I think the argument can be made that they have grown much more materially than Ghana has.
Fair enough. Kofi, let's step back a bit. Where is Ghana's economy? Because in your premise, your article, you said that, Ghana's economy was doing pretty well 2017 to 2019, 2020. And then when COVID came, things went out the window. But you sort of think that beyond COVID, quite a number of things went wrong, including overborrowing and excessive spending, which brought us to where we are. The recent budget suggested that we had turned the corner. Would you agree with those who say Ghana's economy has turned the corner?
No, I don't think Ghana's economy has turned the corner. I think Ghana's economy is in a period of stabilization, and that stabilization will take the next 3 years. Look, Mavis Owusu-Gyamfi, who, the EVP of ACET, Africa Center for Economic Transformation, I believe you interviewed her about a week or two ago, and she spoke very eloquently. Ghana's growth rate is 2.8%. Ghana's population growth rate, GDP growth rate is 2.8%. Population growth rate is 1.9%. So net, we're really growing at just below 1%. And if you look at the forecast over the next 2 to 3 years, they're the same. You're talking about GDP growth rates of 2.5 to 3%, population growth rates similar, 1.5 to 2%. So net, we are just essentially going to be flat to growing a little bit. Now, the future is what's important, because if post the IMF leaving and post the IMF deal ending, if we are able to, one, sustain the optimal reserve ratio, but more importantly, implement fiscal policies which will curb the reckless borrowing that we engaged in, and two, also check the systemic corruption that has occurred in Ghana over the last 7 years, then we stand a chance.
All right, do you think the economic challenges we face were more monetary side problems or fiscal side problems?
They were both. They were both fiscal and monetary. If you ask me, I think the primary problems came from the fiscal side. Now, on the monetary side, listen, the central bank has its primary role is the following: price stability and curbing excessive spending. The primary tool the central bank has is interest rates. And that's the primary lever of trying to curb both excessive spending and price stability. But when you have on the fiscal side, this just reckless, just absolute, at the time that they were raising all these Eurobonds, they could have gone for concessional financing. There was concessional financing available at better terms to Ghana, but they did not go for it. I just don't know what to say.
So you think the fiscal is more to blame than the monetary, although the monetary may have played a role as well. I'll take a break. When I come back, we'll try and look at the relationship between inflation, interest rates, and the exchange rate, because it seems like those three keep getting mentioned in the same sentence. We need to try and understand some basics here. Is the inflation rate in Ghana high because the interest rates are high, and as a consequence, the exchange rate becomes problematic, or where does this start from? And then we'll get more into this gold thing and whether the government's gold for oil thing was a product of Mr. Akar's suggestion. We'll be back with more. Stay with us. This is The Point of View. We're looking into the economy of Ghana. We'll be right back. Welcome back. This is The Point of View. Tonight we're looking into the economy of Ghana. My guest, Kofi Akar. The name may sound familiar because Kofi also happens to be the son of former Vice President Kong Kensington Akar. And you'll notice he mentioned in the interview that he was the policy lead for CPP, or the arrowhead for CPP when it came to the economy. We don't know if he's still a member of the CPP and what he thinks of the CPP's chances. But Mr. Akar, his dad, was an Nkrumahist, and he had that infamous spat with Jerry John Rawlings, was vice president between 1993 and 1996-97. And of course, Kofi has been talking about Ghana's economy. He himself worked at the IFC, which is an arm of the World Bank, and he's been shouting from the rooftops about why we need to strengthen the cedi with this gold thing. I'll come back to that gold issue. But Kofi, I want us to wrap up on the basics before we get into the full analysis. So the Bank of Ghana's Monetary Policy Committee is going to meet. I think they're meeting in a few days' time. The last time they met, they reduced the rates, the main rates, the so-called policy rate by 100 basis points from 30% to 29%. That was after 6 months of having it at 30%. Togbe Afede, who's been on the BOG board before, who's a chief business leader, essentially says this is a timid, laughable reduction. He feels like for the past 20 years or so, the Bank of Ghana's monetary policy rate has not been bold enough in reducing the rate, and therefore inflation has never really come down. He thinks that we should be bolder in cutting that rate, push inflation down, and everything else will benefit. What do you make of the rate? It's 29%. Is that rate the most important indicator of where the economy is? And is the BOG missing a trick by being very conservative in how it tries to slash it?
Well, I think, look, and again, there's a wonderful professor here at Georgetown University, Ghanaian professor, a guy called Ken Opalo. And he just published an article. And there's a sentence in there which is very applicable. He makes the statement: a depreciating currency leads to rising inflation. Okay? A depreciating currency leads to rising inflation. So if your currency is depreciating and it's causing inflation, there's only one instrument that the Bank of Ghana has in order to try and bring down inflation, and that's interest rates. And so, whilst inflation, has dropped, and it's dropped as you illustrated, Bernard, from 54% over the last year and a half or so to about 23.2% right now. The exchange rate has somewhat stabilized. I mean, it's still depreciating, but at a much slower pace. So at this point, the monetary policy rate is at 29-30%. What do I think the Bank of Ghana is likely to do? I don't think the Bank of Ghana is likely to cut rates at the next meeting, or probably at the following meeting after that. The reason being the following. I mean, we're in an election year, and it's all political economy. So election year, there's going to be increased spending. Increased spending means inflation is likely to tick up slightly. With inflation likely to tick up slightly, I don't think it's in the best interest of the economy for the Bank of Ghana to be cutting interest rates at this point in time.
But Kofi, let me take you on that. There's a view that some of our inflation is supply side. So if inflation can either be monetary cost, as in excess money chasing fewer goods, or sometimes if there's an external shock, maybe there's a disruption in supply, prices of goods go up, so there's imported inflation. So there's a bit of that. So that's what we call cost push, right? So if you import your raw materials, and your raw materials are dollar denominated, as you said, currency depreciates, it leads to imported inflation. So not all our inflation is monetary, that's number one. Number two, if you say you are mopping up excess liquidity, and yet you're borrowing at 31% T-bill rate, you're essentially delivering excess liquidity into the system with the T-bill rate policy, right? So my question more has to do with the way we see interest rates in a developed country like US or Japan may not be the same in a country like Ghana or Nigeria. So its usability and it's the way we are conservative in reducing it, as the theory says, may not necessarily work in a country like Ghana, which is why for 25 years, the Bank of Ghana has never really been able to achieve its inflation targeted rate.
I agree with you, Bernard. I mean, let's take a step back. I mean, let's look at some of the developed countries, right? So Japan, for example, is running negative interest rates. I don't think, Ghana economy, I come from the camp of orthodox economics. I don't think Ghana should be thinking about implementing negative interest rates or anything like that. We're not there. Our inflation, as you probably pointed out, is coming from two sides. It's coming from both, the monetary policy side, but also from the supply side and also from the fiscal side. So overall, when you look at the T-bill rates, what the Bank of Ghana is trying to achieve with the T-bill rates of around 35% or so is that they need to generate revenues. And the only way you can generate revenues is to provide investors with a real return. So the investors, they're looking at an inflation rate of 23.2%. You've got to have a T-bill rate that's higher than that. So the real return is, you're talking about 12% or so to the investors.
But
that's what's going to attract investors.
But you're also aware that by having a high T-bill rate, you are going to create an inverted yield curve, which I know you know better than I do, that if you just did a debt exchange where you give people longer tenors and shorter returns, you basically bought their debt and you extended when you're going to pay them. So somebody goes for a 10-year government bond, you're paying back in 15 years. He went for it at 25%, you're going to give him 18%, right? This is the debt exchange you finished last year. This same government is now borrowing for 1 year at 34% or 32%. So you are basically rewarding short-term behavior to long-term behavior. You're creating an inverted yield curve. The yield curve has to be longer risk, longer tenor, longer return. Now, you know better than I do that if you do that for 2 quarters, you're going to lead to a recession. So I'm going back to the overall policy of government with this treasury bill thing. And I'm saying it may give you some respite to have better numbers to say you're paying back your debts, but you're actually digging a hole for whoever's going to win the election in 2024, aren't you?
I agree with you 100%. And I mean, look, again, coming back to the 5 pillars of my fiscal policy that I talked about, energy. I mean, look at what's happening in the energy sector. Our debts have skyrocketed. And whoever comes in, the next administration is going to face a major challenge in the energy sector and in other sectors. I mean, labor, education, financial sector is moribund right now. I speak to a lot of people in that sector, and unfortunately, due to the way the economy was managed, and there's hardly any activity. Now, we are in the process of stabilizing the economy, but we're also in an election year. So in the election year, there's going to be spending, there's going to be slightly higher inflation, and it's all about what happens post the election. So post the election, will the new administration come in and will they make a significant strategic decision, as you're saying, Bernard, to work on that T-bill rate and bring that T-bill rate down? The way to do it is to do it in tandem with, one, stabilizing your currency, and we're stabilizing the currency through the optimal reserve ratio, and bringing down inflation. And you can bring down inflation by curbing the excessive spending. Unfortunately, the excessive spending is still going up. We'll see what happens with the next administration. Thank you. Let's come to
your proposal that you did in 2017. Your premise was that even though the gold standard was not adhered to since 1971, essentially currencies prior to 1971 needed gold to back the numbers. The US dispensed with that in 1971. You are saying advanced countries are all aggressively buying gold to back up their currencies. You mentioned Europe, you mentioned China. Can you elaborate a bit on why, even though the gold standard has been discarded, more and more strong countries are aggressively buying gold? Why are they doing that?
Well, it's the primary things are following. One, if you look since the 1930s, the US dollar has lost 99% of its value against gold since the 1930s. Okay? Mm-hmm. Now, two, if there are 5 reserve currencies in the world: the dollar, the euro, the yen, the Chinese yuan, etc. The Chinese yuan was the most recent reserve currency to get ascension. What China did once they became a reserve currency was they realized that, oh, wow, they looked at the US, they looked at the European Central Bank, and they realized that their optimal reserve ratio was 2%. And therefore, their currency was also depreciating at a much higher rate against the gold versus the dollar. So they've been buying like crazy. China Central Bank, the Russian Central Bank, Singapore, Poland, Turkey. I mean, last year was the largest purchase of gold, monetary gold, by central banks since the 1950s. Okay? Mm-hmm. So if, again, a depreciating currency leads to rising inflation. So if the dollar, one, is already depreciating against the gold, and two, your currency is also depreciating against the dollar, you've got a double whammy. So if you keep a certain significant optimal percentage of your reserves in gold, your currency will not depreciate as much.
That's the
basic.
Let's come to the Ghana question. Ghana produces at least 100 tons of gold every year, and yet as of the time you started checking, I think 2021, you said we had less than 10 tons of gold in our reserves. And your argument was that we needed to increase that by a certain ratio. Why do you think, even though we produce 100 tons of gold every year, less than 10% of that is kept in the vault?
Great question, Bernard. I mean, this is a question to ask our political and economic leadership over the last 60 years. I cannot understand it. I mean, we all went to the same schools. We all studied the same macroeconomic theories. I mean, we all worked at the same institutions. And I mean, we all do the same research. So I'm no rocket scientist. All I did was I looked at flows. And when I looked at flows, I decided that, hey, there's something going on here. And monetary policy was changing for the 21st century. So I decided to do more digging and more research. And this is what I came up with.
Do you think that the government's gold for oil policy was derived from this article you wrote, but they're refusing to give you the credit? Because if you look at that gold for oil policy, Ghana has managed to now rack up its gold reserves from 8 tons to close to 25-ish. Do you suppose that this was the basis for that policy?
Well, I mean, the good thing about the gold reserve policy is, and monetary gold, is that, you know, it's a good substitute for cash. So you can use gold cash, particularly for your large value items. So whilst I don't know for sure whether or not the gold for oil policy was derived from the gold reserve policy, you really cannot have the gold for oil policy without the gold reserve policy. So, and in fact, Bernard, further thing to say, I believe over the last couple of weeks or so, the Bank of Ghana has made mention that they are going to start eliminating the gold for oil policy. It was a temporary policy, but most importantly, they're still going to maintain the gold reserve. So that's all I got to say. You really need to ask.
But can the gold reserve
from the Bank of Ghana and the administration?
Can the gold reserve policy work without refining? Because we know that the country that really benefits from the gold prices is Switzerland. They have some of the best reserves in the world. We have a minor reserve somewhere in Ghana. I think 2016 a reserve was set up. Can we be consistent with this buying of gold thing if we don't develop our refinery capacity?
Fantastic. No. The plain answer is no. We need to develop, to grow our refining capacity. And one of the things I said back in 2017, we had a refinery already established. We needed to issue a license. I was saying we needed to issue a license for a second refinery so that, one, we're able to basically refine all our gold. We need to control our gold in Ghana. We cannot let this gold keep flying out in raw terms to developed countries, because it turns around and it comes back to us in the form of inflation. So we need to implement this. It needs to be done now, and that's the right thing to do, Bernard.
Just a final point here. So we have racked up quite a number of, or a sizable chunk of gold, 26 tons of gold, $1.73 billion. But we bought a lot of that with oil. So are we basically saying that the projected price of gold is going to be better than that of oil, for which reason we're substituting one for the other? I'm just trying to get a sense into the logic behind the gold for oil. If you're going to convert your oil into gold, then the premise is that you expect gold prices to do better than oil, for which reason you substitute one for the other. Is that a logical conclusion?
Well, honestly, I don't know what they did with the gold for oil policy. What I do know is what His Excellency, the Vice President, said. He said that the gold reserve policy saved Ghana $1.73 billion. Now, he said gold reserve and gold for oil together saved Ghana $3 billion. So the majority of the savings to Ghana came from the gold reserve. If I knew the exact machinations of what they did with the gold for oil, I could speak clearly to it, but I don't.
When we come back, we'll look at your your outlook for the currency, it's inching close to 13. Where will it go as we approach election year? And we'll also take the final highlights of your 5-pronged economic program that you wrote for the CPP, whether it's still relevant for this year. All of that and more. Point of view, my guest Kofi Akah, financial economist. Stay with us. Welcome back. Point of view tonight is heavy on economics. We're trying to break it down. Guest Kofi Akah, who's a financial strategist, 30 years working in the sector. He's done World Bank IFC, he's done Northwest Bank, ARC Partners, Volvo, etc. Son of former Vice President Konkensen Akah. He says we should transform Bank of Ghana's gold reserve policy to shore up the currency. And he believes that the stability of the currency we've seen in the past, probably 9 months, is because of the gold reserve proposal that he made and partly the implementation of that by the central bank. Kofi, the currency as of the last time I checked is inching towards 13 cedis to the dollar. Do you have an outlook? When you look into the crystal ball, where will the dollar end? And is that based on the continuation of this policy at all? Can you give me a prediction?
Fantastic. Well, I checked today, and the Bank of Ghana rate is 12.55, but the Forex rate is 13.1. What do I think? I mean, again, so, you know, I think we'll talk about this maybe a little bit later. But, you know, there's that spread there, and that spread could cause a problem if ever Ghana moves to a free-floating exchange rate regime. We'll talk about that later. However, 12.55, where do I think the exchange rate to the dollar will end the year at? I think inflation will take up slightly because of spending for the election. I think, you know, the Bank of Ghana rate is probably going to end up at the end of the year around let's say 12.8. And then, you know, come at the beginning of next year, of course, you have what's going to happen is we have the cocoa loan. We all know the inflows that come in. Cocoa loan comes in between November and February. That's going to, you know, serve to also shore up the city a little bit. So overall, I think monetary policy rate remains flat. Inflation, slight uptick, but really remains flat. And the exchange rate, you're going to have maybe just a slight depreciation again of the currency.
I don't know if you're following the situation in Nigeria.
Will remain flat.
I don't know
what happens. Go ahead, sir.
I don't know if you're following the situation in Nigeria, but we do know that they're facing a scarcity of USD. The currency is depreciating pretty badly. Inflation is high. And the Nigerian government arrested the principals of a company called Binance because they suspect there's a relationship between this Binance, which we understand is a forex trading crypto kind of platform, for their currency problems. Just quick question. Is there contagion between Nigeria and Ghana? Anything else you can say on what's happening in Nigeria and how worried should Ghana be about what's happening there and its possible effect on us?
Yeah, I mean, Nigeria has faced two challenges which have affected the currency and also with inflation. I mean, the first thing was that they removed the currency peg. And that was an artificially constructed exchange rate by the Bank of Nigeria. The second thing was they removed the fuel subsidies. This has served to basically devalue the Naira somewhere between 60 to 80% over the last year or so. Now, what problems can these problems be replicated in Ghana? The answer is yes, but not at the level that we've seen in Nigeria. Let me give you some more stats. Today, Nigeria's optimal reserve ratio stands at 2.89. 2.89. think about how weak of a foundational pillar that is. Think about if they were able to, again, transform their reserves where, I don't know, 30% odd would be in gold, they would not face the depreciation of the currency that they have. Now, Ghana has implemented the optimal, I think they have the optimal reserve ratio regime. If they were to keep it going, then I think in the future, because I think what's going to happen in Ghana is the same thing that happened in Nigeria. We are going to move to a free-floating exchange rate. And once we do, you're going to have that convergence of the Bank of Ghana rate with the Forex rate. Once that happens, once we move to that free-floating exchange rate, and that's not going to happen, by the way, now before the election. No administration will do that. It's likely to happen in probably late 2025, maybe 2026, as we're coming to the end of the IMF regime. Once that is done, we are likely to see a depreciation of the cedi, but we're probably looking at maybe a 15% depreciation of the cedi at that time.
It's not a very positive note to end, but we have to, Kofi, and I hope to talk to you again soon, to crack the economic program that will solve this for us. By the way, are you still a member of the CPP? Do you still think for them? Do you still write for them at all?
I'm always going to be a member of the CPP in my heart. As you know, my father was a member of the CPP, and I have really, really fond memories of his contribution to Ghana. And I wish all parties best of luck. I think the future for Ghana is mixed, and particularly over the next 2 to 3 years. But the future could be bright beyond that. So medium to longer term, provided that we maintain discipline in the optimal reserve ratio, and we put together a credible fiscal policy fit for the 21st century, where we curb all of the reckless borrowing, and we also curb the systemic corruption. And until we do those two things, we're going to be in a position of mixed signals for quite a while.
Thank you, Kofi Aka, who's a financial strategist working previously with the IFC, talking to us. He's also the son of former Vice President Kwon Kensen-Aka. We've been trying to understand where Ghana's economy is, looking at the causes of our challenges. He says we haven't turned the corner, but he thinks with a better optimal reserve ratio, i.e. having more of your reserves in gold, you have a better chance of economic stability than if you did not. Thanks for watching. Hope you've learned a few things about the economy. We'll see you next time here on The Point of View. Have a good night. Bye-bye.